So now in the last video segment, let me go ahead and do a few things to show why we care about the CPI beyond purely just measuring inflation. And the first thing I want to talk about is correcting economic variables for the effects of inflation. If we go out and listen to media reports or talking heads or that sort of thing, of course people talk about the sales of some particular industry have grown by, say, 30% since the year 2000, or federal spending on blah is down or up or sideways or whatever, some amount from some certain point in time here. And a lot of times it's very unclear whether or not these numbers have been corrected for the effects of inflation. And that can actually be really important. So in particular, let me go ahead and say, let's suppose that inflation in the United States has been about 3% per year since the end of World War II, which is what it's actually been, a little bit higher, but that's good enough for government work. And let's say we've had 13 years pass since the year 2000, and we've had some industry or some company, its sales were $100,000 in the year 2000, and they were $130,000 in 2013. And you can see probably, fairly easily that this company's sales have grown by, they've grown by about 30%. So you could probably see that without me doing the math, but it never hurts. On the other hand, what happened to general prices over the period? Well, if we had something growing at 3% per year for 13 years, then we would do a compound growth calculation. So how much have general prices gone up over that same interval? Well, general prices have gone up by 46%. So if this company has only seen its sales grow by 30% over that period, and prices other places in the economy have gone up by 47%, then in real inflation-adjusted terms, this company's sales have gone down. And so, you can see where someone could get fooled. I mean, wow, it looks like they're growing. And as Obi-Wan Kenobi said to Luke Skywalker, from a certain point of view, that's true. Of course, that's not actually true that the sales have grown in any real economically meaningful way. It's really kind of deceptive to call this a growth in sales, because once we correct for the effects of inflation, it's really a shrinkage. So, how do we actually deal with this sort of thing? Well, we have the formula for it right here. So to convert something to some equivalent amount in today's dollars, we take the amount in the earlier period and multiply by the ratio of the price levels. So we multiply by price level today over price level in year T. So as a particular example of this, let's suppose that your income, your nominal income, the income that's actually on your paycheck, grew from $20,000 in 2007 to $22,000 in 2009. At the same time, the CPI increased from 112 to 120. So, now fairly clearly, this $20,000 was worth more than $20,000 because the prices were lower in 2007 than they were in 2009. So how do we actually do this? We go ahead and we use this formula. So in this problem, today is 2009, time t is 2007. So we're going to go ahead and go over to our spreadsheet here, and our relevant values are $20,000, $22,000. When our income was $20,000, the price level was 120, the CPI, 112. When it was $22,000, our price level, our CPI was 120. So to convert this $20,000 into a number that's equivalent in equivalent dollars, we multiply by the price level today over the price level at time t. So, making $20,000 when the price level is 112 is like making 21,428 when the price level is 120. Or our income in 2007 was 21,428 in 2009 dollars. And it's a little bit tricky to sort of talk about these things in just the right way, and it's a kind of awkward idea, so there really isn't a smooth way to talk about it. We could also do the other sort of comparison here. We could compare everything to what it was in 2007. So you can see that, like, yes, our income grew, but prices also grew. Part of our increase in income was just keeping up, hopefully, with inflation. Our income was inflated, so we could go ahead and deflate it to get it back to something comparable in 2007. So that is the next slide here. So now we're asking the question, in 2007 dollars, what was our 2009 income? So the whole thing about in-year blah dollars tells us what our yardstick of value is. We're using 2007 now in this problem as our yardstick of value. So when I go back to Excel, instead of taking a 2007 amount and then converting it into 2009 dollars with, notice here, the year we're converting into goes on the top of the fraction. The year that we're converting from goes on the bottom of the fraction. Now we're going to do it the other way around. We're going to take our year 2009 dollar value and multiply by the ratio of the price levels. The year that we're converting into, that price level goes on the top. The year that we're converting away from goes on the bottom. And we see that making $22,000 in 2009 was like making $20,500 in 2007. So that's the basic idea with these sorts of comparisons. The other thing that we want to look at using the CPI and inflation rates for is the difference between what we call a nominal interest rate and a real interest rate. And the nominal interest rate is the one that you experience directly in everyday life. And, that would be the interest rate on the contract for the loan or in your credit card agreement or something like that. And that's the interest rate that you're going to pay taxes on. But economists like to sometimes look at what we call the real interest rate. And the idea of the real interest rate goes something like that. Let's suppose you put $1,000 in back. We don't want to put $1,000 in back. We want to put $1,000 in the bank. We put $1,000 in the bank, and we earn 15% interest. Well, if we take $1,000 and we're going to earn 15% on it, then the amount we're going to have at the end of the year is our initial principal, $1,000, plus our principal times our interest rate. So we get our principal back, that's this first G14, and then we get an amount of interest income equal to our principal times our interest rate. So we get $1,150 at the end of the year. 1,000 of that just being getting our principal back. But if prices have risen, what's that actually worth to us? We can go ahead and relate this back to this formula over here. Let's suppose that, I'm going to move these around a little bit here. Okay. Move this guy here, up there. Just trying to make it as parallel to the other problem as possible. Let's suppose this is 2008, and this is 2009. And let's suppose the price level in 2008 is somewhere between 112 and 120. Let's suppose it's 114. And we know that the price level in 2009 was 120. Well, this $1,150, what's it actually worth? Well, we want to go ahead and convert it to year 2008 dollars. So we're going to take this money and multiply it by the ratio of the price levels. The year that we want to convert into goes on the top of the fraction. The year that we want to convert away from goes on the bottom of the fraction. And we see that our $1,150 is actually only worth $1,092 after we sort of think about the effects of inflation. So some of that 15% was really just covering inflation. So instead of earning 15%, we actually earned more like 9.25%. And that's the general idea of the real interest rate. The real interest rate attempts to take the nominal interest rate and subtract off something to correct for the effects of the inflation. So this question hopefully is pretty easy and you can tackle it in your review. Let me go ahead and point out that there are actually two different real interest rates out there. And the reason for this, of course, is that inflation is unpredictable. So what typically happens here is that people enter into a contract with some expectation that there will be some level of inflation. And so there's what we call the ex ante, like you ante up in poker, the before the fact expected real interest rate. And to figure that out, we take the nominal interest rate, which we can directly observe, that's part of the contract, and then subtract off people's expected inflation rate. And we might learn what their expectations are, say, just by simply asking them, and then we could figure out what the real interest rate they expect to occur on the contract is. On the other hand, expected inflation and actual inflation almost never match up. Reality almost never exactly matches up with people's expectations. So the ex post, or after the fact, actual real interest rate is we take the nominal interest rate and subtract off the amount of inflation that actually occurred. So as an example here, let's think about this one. If the nominal interest rate is 6%, and everyone expects inflation to be 2%, but then it turns out to be 3%, what's the situation? Well, you can go ahead and pause and go back and look at those formulas and try and work it out for yourself. Now let me go ahead and talk about it. Basically, people were expecting to pay 4% above inflation. So they expected inflation to be 2%. They were going to be paying 6% interest. So the expected real interest rate is the nominal interest rate minus the expected inflation rate. So 6% minus 2%, or 4%. And what was the actual real interest rate? Well, the fact that inflation was higher means that the loan was repaid with dollars that were worth less than the borrower, and the lender thought. So that means the effective interest rate was lower than people thought, because the lender got less compensation or less payback than they thought. Yes, they got 6% return in terms of dollars, but if they look at the actual goods they're able to buy, the fact that there was higher inflation means that they got less return in terms of goods. Likewise, from the point of view of the borrower, the fact that they're able to repay the loan with dollars that are worth less than they thought they were going to be is a good thing. And so we see that the ex post real interest rate is going to be 6% minus 3% gets us to 3%. So the fact that the inflation rate is 1% higher than expected means that the effective real interest rate is about 1% lower than expected. This one I'm going to go ahead and let you guys puzzle out on your own rather than going through the mechanics. What do we tend to see out there when we look at this kind of thing? Nominal interest rates move up and down for a variety of reasons, and we'll talk about Federal Reserve policy and so on and so forth later. But if we just sort of compare what happened to the nominal interest rate to what happened to the real interest rate, what we see is that the real interest rate swings around as well. And in particular, we can see that real interest rates can actually be negative. If the nominal interest rate is not too high and the inflation rate's actually higher, then when we subtract off that inflation rate, we get a negative real interest rate. And what's going to typically happen here with negative real interest rates is that all sorts of crazy economic activity that's not actually profitable starts to become profitable. Let me do a secondary example on this about why we care about inflation. So let's suppose we have two countries. So we have the US and we have Argentina. And Argentina, people expect a higher inflation. And if we think that, one model of how people might behave is that banks might lend money at some constant markup above expected inflation. So let's suppose that banks in Argentina and the US both are willing to lend initially at 3% above the expected inflation rate so that they can get a 3% real rate of return. What we tend to see out there is that when inflation tends to be low, it tends to be more predictable than when it's high. So suppose in the US, with its 3% average inflation, inflation is sort of a coin flip. Heads, it's 2%, tails, it's 4%. In Argentina, with its 30% average inflation, heads, it's 20%, tails, it's 40%. If we sort of run through the math on this, this means that when the coin comes up heads, the US bank gets a real rate of return of 4%, and when it comes up tails, it gets a real rate of return of 2%. So there's some degree of uncertainty here, but not a huge amount. In Argentina, on the other hand, when inflation comes up heads, it's low, we get a 13% rate of return, which is a lot higher than the 3% rate of return than we thought. On the other hand, if the inflationary coin comes up tails and inflation's 40%, then the real rate of return is 33% minus 40%, or negative 7%. So, even a relatively safe lending proposition starts to look pretty risky in real rate of return ways of looking at it here. And then probably correspondingly, banks in Argentina are not going to be willing to lend for just 3% above expected inflation. They're going to need or want to see compensation for this extra risk that they're running, and that could have bad effects elsewhere in the economy. So the idea again here, these high and variable inflation rates can make safe projects pretty risky, and therefore people won't want to undertake those kinds of investments. And a more subtle thing to notice here is that the bank can be promised a real rate of return on its loan. It can be promised a nominal rate of return on its loans, but because of inflationary considerations, real rates of return are almost always risky.